If my previous video I mentioned about the 5 stocks that DBS research report did not cover, however, I realized that I should give an in-depth review of the report itself, as it may be useful for our audience. Most people think tariffs are just taxes on imports, a tool to protect local jobs or punish trade partners. But what if I told you that tariffs, especially the ones proposed by Trump, could shake up the global economy in ways few expect? Many investors believe tariffs are just political noise, something that will blow over. But the truth is, these new tariffs could trigger a chain reaction, impacting everything from your investment portfolio to the price of your next car. Here's the twist. While tariffs are meant to help the US, they could end up hurting American consumers, global supply chains, and even the very companies they're supposed to protect. The real winners and losers might surprise you. Why should you listen to me? I'm Iggy, and I've been covering stocks, finance, CPF, and all things wealth for years. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. Today, we'll break down the latest DBS report on Trump's tariffs, page by page. We'll look at the big ideas, the numbers, and what they mean for you as an investor. We'll cover the new tariff structure and who gets hit hardest, how companies and countries are reacting, the ripple effects on key sectors like autos, semiconductors, and pharma, what this means for Asia, especially Singapore, India, and ASEAN, the bigger picture, global markets, currencies, and the new world order. Ready to see how tariffs could change the game? Let's dive in. Trump's new tariffs aren't just tweaks, they're a full reset. The US is rolling out a 10% baseline tariff on all imports, with even higher rates for countries seen as bad actors. For example, China faces a 54% tariff, Japan 24%, and the EU 20%. Canada and Mexico are spared from the worst, but still face 20% tariffs on most imports. And auto tariffs, a whopping 25% on all foreign-made cars, effective immediately. Why does this matter? Because these rates are much higher than anything seen since the 1930s. Back then, tariffs helped trigger the Great Depression. Today, the stakes are just as high. Imagine paying 25% more for a car or seeing your favorite tech gadgets jump in price overnight. Rhetorical question. If tariffs are supposed to help US workers, why do they end up costing consumers more? China isn't sitting still. With reciprocal tariffs and past levies, the total rate on US goods tops 60%. This tit for tat means companies can't just reshore production to the US without facing higher costs. Countries like Vietnam, Taiwan, and South Korea are also in the crosshairs, with export shares to the US ranging from 5% to 35%. Analogy. It's like a game of whack-a-mole. Move your factory from China to Vietnam and suddenly Vietnam gets hit with tariffs too. For company leaders, the focus is on survival. They're triaging investment portfolios, managing liquidity, and hedging against market swings. There's a rush to reassess credit, cargo, and political risks. Boards and regulators are on high alert, and everyone's rerunning solvency checks to make sure they can weather the storm. Practical tip. If you're an investor, now's the time to check your own portfolio for exposure to global supply chains. Trump's model contains 4 key contradictions. It seeks to tighten immigration while promising lower living costs, cut taxes but also reduce the fiscal deficit, impose tariffs while claiming to boost competitiveness, and pursue both a weaker US dollar and lower interest rates at the same time. These goals clash with each other, making it impossible to achieve them all at once. Trying to do so risks opening a massive can of economic and financial worms, and efforts to force other countries to stop using the US dollar or to appreciate their currencies could backfire, leading to global instability. The US imports over $213 billion in passenger cars. Top sources are Mexico, Japan, South Korea, and Canada. With 25% tariffs, these countries and US consumers will feel the pain. Prices will rise, and supply chains will scramble to adapt. Example, if you're eyeing a new car, expect sticker shock. Semiconductors are the brains of modern tech. The US imports $82 billion worth, mainly from Malaysia, Taiwan, and Vietnam. Tariffs here could disrupt everything from smartphones to electric vehicles. Companies may try to shift production, but the web of suppliers is too complex to untangle quickly. Pharmaceutical imports are even bigger. 247 billion, with Ireland, Switzerland, and Singapore as top suppliers. Tariffs could raise drug prices and disrupt access to critical medicines. For investors, this means volatility in healthcare stocks and supply chain headaches. Rhetorical question: what happens when life-saving drugs get caught in a trade war? Companies face tough choices: pass costs to customers, accept lower profits, or risk solvency. The entire supply chain feels the squeeze, from raw materials to finished goods. For investors, this means watching for margin compression and potential bankruptcies in vulnerable sectors. DBS forecasts show GDP growth taking a hit across Asia and the US. China, India, and Vietnam could see growth drop by up to 2%. Retaliation could make things worse, while deal-making might soften the blow. The message is clear: tariffs are a drag on global growth. Example: Vietnam's growth could fall from 6.8% to 4.8%, a big deal for a fast-growing economy. China's exports to the US are already down, and new tariffs could cut total exports by over 10%. The impact on China's GDP is real, with each 10% tariff increment shaving off about 0.25% from growth. Hong Kong, meanwhile, is less exposed. Local goods to the US are just 0.13% of total exports. Insight: the trade war is shifting global trade flows, not just hurting China. Electronics and machinery make up 42% of China's exports to the US. After the new tariffs, the average rate jumps from 13% to 54%. Sectors like toys, textiles, and chemicals are also hit hard. The message: no sector is safe from the tariff wave. Analogy: it's like raising the hurdles in a race. Every runner slows down. Hong Kong's role as a re-export hub is shrinking. Only 1.3% of its exports are locally made, and just 10% of those go to the US. The bigger story is the drop in re-exports between China and the US, down from 10.6% in 2014 to 5.7% in 2024. Taiwan faces a 32% reciprocal tariff and has high export exposure to the US. The country is considering policy responses like boosting US imports, investing in US manufacturing, and fiscal stimulus. But there's no easy fix. Example: Taiwan's tech sector, especially semiconductors, is in the hot seat. Japan, South Korea, and Taiwan are all looking at ways to soften the blow. Options include increasing US imports, investing in US factories, and monetary easing. But each country faces unique challenges, and not all have the same tools. Insight: policy responses are like band-aids. They help, but don't solve the root problem. India is now in the US's sights with a 26% reciprocal tariff. The US trade deficit with India has doubled since 2015. Key sectors like iron, steel, pharma, and electronics face tariff gaps of 5% to 22%. India has tried to lower some tariffs, but the impact could still shave 0.3 to 0.5% off GDP growth. Example: India's pharma exports are a bright spot, but other sectors are vulnerable. Singapore faces a 10% baseline tariff, the lowest among ASEAN 6. The US-Singapore Free Trade Agreement helps, and the US is still a top export destination. Key exports include pharmaceuticals and semiconductors, but a global slowdown could still hurt Singapore's open economy. Analogy: Singapore is like a small boat in a storm, well built, but still at risk from big waves. Indonesia gets a 32% tariff, despite a balanced trade relationship with the US. The country's strong ties with China could be a flashpoint. Key exports like electronics, apparel, and footwear are at risk. Growth impact is more notable after higher tariffs. Rhetorical question: why target Indonesia when the trade gap isn't that wide? Vietnam, Thailand, Malaysia, and Indonesia are among the hardest hit by US tariffs. Vietnam and Thailand have the highest export exposure to the US. The region faces a tough road, with growth likely to slow and supply chains disrupted. Investors should watch for opportunities in countries that can adapt quickly. The report warns of stagflation light, slower growth, and higher inflation US yields are depressed, while Asia may use monetary easing and fiscal support to cushion the shock. The result? Diverging bond yields and more volatility in global markets. Insight: tariffs aren't just about trade, they ripple through every asset class. Trump's tariffs serve multiple purposes: bringing manufacturing back, raising revenue, and using them as bargaining chips. The US could collect up to $400 billion in tariff revenues, but some tariffs may stick, especially if they're seen as protecting key industries. Bond yields are diverging globally. US exceptionalism is fading, while Asia is preparing for monetary easing. Asian currencies are more vulnerable to trade tensions, with the Chinese yuan under pressure. The People's Bank of China is working to keep the yuan stable, but volatility is likely. The immediate future is all about retaliation, bad for risk assets, but negotiations could follow, offering some hope. The Dalai Lama is quoted, "Just as ripples spread out when a single pebble is dropped into water, the actions of individuals can have far-reaching effects." The same goes for tariffs. The world is shifting from free trade and multilateralism to protectionism and multipolarity. Supply chains are regionalizing and global institutions are under strain. The China Plus One strategy, diversifying away from China, faces new hurdles as tariffs spread to other Asian countries. Analogy: the global economy is like a chessboard. Every move creates new risks and opportunities. Credit spreads are widening, especially in Asia. Investors are demanding higher returns for taking on more risk. This is a sign that markets are nervous about the impact of tariffs and slower growth. Stay alert for changes in credit markets. They often signal trouble ahead. Let's wrap up. Today, we broke down the DBS report on Trump's tariffs, page by page. We saw how new tariffs are shaking up global trade, hitting key sectors like autos, semiconductors, and pharma. We looked at how countries from China to Singapore are responding, and why investors need to watch for ripple effects in markets, currencies, and credit spreads. The big takeaway? Tariffs aren't just a political tool. They're a force that can reshape the global economy. For investors, this means more volatility, new risks, and fresh opportunities. The winners will be those who adapt quickly and keep an eye on the big picture. If you found this analysis helpful, drop a comment below. What's your biggest concern about tariffs? Don't forget to like and subscribe for more deep dives on global trends. Thanks for watching, and remember, in a world of change, knowledge is your best investment.